Welcome back to the Deep Dive. Today we are flipping the script a little bit, going full talk tickers mode.
I like it.
You know the drill by now. We're stripping away all the corporate gloss, ignoring the PR, and getting straight to the numbers that actually move markets.
And today's is a good one.
Oh, it is. Today we are unpacking a fascinating and frankly a pretty violent quarter for CSW Industrials. Tickers CSWI.
Violent is the right word.
Yeah.
The earnings call was January 29th, and if you looked at the stock chart right after, it just looked like a heart attack.
It really did. And for anyone who doesn't follow them, CSW Industrials, they make all that stuff you don't think about until it breaks. You know, HVAC parts, plumbing sealants, industrial lubricants.
The boring stuff that makes the world run.
Exactly. And they've been a market darling for a while. But this quarter, something broke.
Well, they broke their own business model in a way, or I should say they remodeled it significantly.
Right. So here's the setup for everyone listening. CSWI spent nearly $1 billion buying up other companies to grow.
Mostly Mars Parts and Aspen, big acquisitions.
And they just reported record revenue. Sounds great, doesn't it? But the market absolutely hated it. The stock just dropped about 7.7% right after the news.
And the volume was huge, over 500,000 shares. Normally they do maybe 150K. That's big money running for the doors.
So our mission today is pretty simple. We need to figure out if this sell-off is a sign that the business model is actually broken, or if this is just the messy, indigestion from swallowing a huge deal.
Indigestion is the perfect word. I've been calling this an integration quarter. When you deploy that much capital, your financial statements just turn into a construction zone. It gets messy.
Okay, let's put on our hard hats and walk through that construction zone. Give us the headline numbers. Straight up, what happened?
All right, cold hard facts. Revenue was a record $233 million. That's up 20.3% over last year.
20% growth. That usually gets you a parade on Wall Street.
Usually. But the street consensus, what all the analysts were guessing, was for something closer to 249, maybe 251 million. So despite the record, it was a miss.
Ouch. So they grew, but not as fast as everyone had priced in. But the real pain was in the profits, right?
That's where the floor just fell out. Adjusted earnings per share, EPS, came in at $1.42.
$1.42. And last year?
Last year, they hit $1.60, so that's a drop. But the real sting is that the street was looking for something like $1.87 to $1.93.
Oh, whoa, pause there. They missed earnings by almost 50 cents a share. That is colossal. I mean, you rarely see a stable company miss by that much.
It creates a crisis of confidence, absolutely.
So I'm an investor here. I see revenues up 20%, but my earnings just dropped off a cliff. How does that math even work? How do you sell more stuff but make way less money?
It's not that they lost control of costs. It's that they fundamentally changed their cost structure. And that brings us to what I call the debt reality. A year ago, what did CSWI's balance sheet look like?
They were flush with cash, right? Super conservative.
Extremely. A net cash position. They're actually earning interest income.
Which is a great spot to be in when rates are high.
Exactly. But to buy Mars and Aspen, they had to spend that cash and then borrow a ton. They deployed about $1 billion total. Now they have net debt of $764 million.
That is a massive swing from earning interest to owing $750 million.
And that debt is not free. Interest expense this quarter jumped to $8 million. Last year, that number was income. That's a $10 million negative swing right there.
I see. So before they even sell a thing, they're already $10 million in the hole compared to last year, just from interest.
Precisely. That interest expense flows straight to the bottom line and just eats your EPS. That explains a huge chunk of that 50-cent miss right away.
Okay, that makes sense. It's the cost of buying the growth. But I want to poke at the quality of that growth. You said revenue was up 20%. If they bought these two huge companies, shouldn't it be up more? Is this real demand, or did they just write a check?
That is the question of the hour, and it is predominantly bot growth. This is a crucial distinction. While total revenue was up 20.3%, organic revenue,
meaning sales from the businesses they already had.
Correct. That actually declined by 2.9%.
Ooh, that's a red flag for me. So if I strip out the shiny new acquisitions, the core engine is sputtering a little.
It's definitely misfiring. And the weakness is all in their biggest segment. Contractor Solutions. It's their bread and butter, makes up 71% of their revenue.
And what was the organic number there?
Well, thanks to the acquisitions, the total revenue for the segment was up 27%. But if you strip out Mars and Aspen, organic sales fell 5.1%.
Down 5%. That feels significant. Management kept using this buzzword on the call, destocking. What does that actually mean for somebody listening?
It's a valid question. Think of it like you're a grocery store manager. You run the soup aisle.
Okay, I'm managing the soup. Campbell's.
During the supply chain crisis, you were terrified of running out, so you ordered way, way too much soup. Now your back room is just full of pallets of tomato soup. Are you going to order more from the factory?
No way. Not a single can until that back room is empty.
That is destocking. The distributors, the people CSWI sells to, they're the grocery store managers. They're just clearing out old inventory.
So it creates this air pocket. The homeowner might still be buying the part, but the order to the factory just stops dead.
Exactly. It creates organic softness. But it wasn't just volume, right? The profitability also took a hit. Gross margin dropped 170 basis points.
Which is just 1.7%. It dropped to 39.7%. Why are they making less on each thing they sell?
This is the other side of the acquisition coin. When you buy a company like Mars Parts, their profit margins on day one just aren't as good as your legacy business.
So you're lowering the class average, basically.
Exactly. Management calls it dilution. Adjusted EBITDA margin fell 250 basis points, so 2.5% down to 19.2. And they also mentioned indirect tariffs raising material costs.
Okay, let me summarize the bear case here because it sounds pretty grim.
Yeah.
High debt, interest payments eating profits, organic sales are falling, and margins are shrinking.
When you put it that way, you can see why the stock dropped 8%.
Right. But then you listen to the CEO, Joseph Arms, on the call. He didn't sound panicked. He sounded surprisingly confident.
He did. And look, he has a solid track record. He's asking investors to look past the messy quarter and focus on the synergies.
Ah, the magic corporate word. Did they put a number on it?
They did, and it's a real bright spot. They originally promised $10 million in cost savings from the Mars deal. On this call, they said they now expect to exceed it.
Exceed it. Okay, that's promising.
And even more important, and this is easy to miss, they said the ERP conversion is already done.
The computer systems, they moved Mars onto their system already.
Already done. In January.
Wow. That's huge. ERP migrations are usually nightmares that drag on forever.
Exactly. The fact that it's done suggests the integration is going much smoother than you'd think. It's a huge de-risking event.
Okay, that's a really good point. But what about the other parts of the business? Let's talk about Specialized Reliability Solutions, SRS. How did they do?
Yeah, it's a mixed bag. Revenue up 10.8%, mostly from acquisitions. But the real story is the action they're taking. They announced a big restructuring.
Layoffs and closing buildings.
Pretty much. Shutting down a headquarters, consolidating distribution. They're streamlining the whole thing.
And when did the benefits of that kick in?
April 1st, the start of their new fiscal year. Their goal is to get that segment back to a sustained 20% EBITDA margin.
So they're taking the pain now for a leaner start to the new year. What about the last segment? Engineered Building Solutions, EBS.
That one was kind of steady but stagnant, revenue down about 1%. The key metric there was the book-to-bill ratio. It was 0.9x.
Whoa, hold on. Can you translate book-to-bill for us? What does 0.9 actually mean?
Sure. It means for every dollar of product they shipped out the door, they only booked 90 cents of new orders.
So their backlog is shrinking.
It is. It's not collapsing, but it's below that replacement rate. They're eating into their future work.
Okay, so a messy present, but management is dropping these breadcrumbs of optimism. They said January orders were encouraging.
They did. They said discussions with customers suggest those inventory levels are finally balancing out. The soup cans are almost gone from the back room.
So that organic decline should flip back to growth, theoretically.
It should. But there's a huge piece of context we need to talk about here, and it's all about the calendar. It's seasonality.
Right.
By buying Mars and Aspen, CSWI is now heavily weighted toward repair and replace for HVAC. Think about it. When do air conditioners break?
July.
Yeah.
August, when it's 100 degrees outside.
Exactly. Nobody is fixing their AC in December. Q3, October to December, is the dead season for this business. So they've magnified their seasonality. The winter dip looks deeper now because a bigger part of their company goes dormant.
That is such a key insight. The acquisitions that made the winter look terrible should, in theory, make the summer look explosive.
Precisely. That is the entire bet. Operating leverage cuts both ways.
So, looking forward, what are the catalysts? What am I watching for?
First, the May earnings call for Q4. Management promised better visibility. We need to see if that encouraging January data held up. Second, can they actually beat that $10 million synergy target? And third, the macro. Does housing demand pick up?
So it's a friction point. Management is saying, look at our scale and synergies. And the market is saying, We hate your debt and your earnings dilution.
That's the battleground.
Which brings us to my favorite part of the show. Time for the This Is Not Financial Advice segment.
Cue the disclaimer. We're not your financial advisors. Do your own research. Don't sue us.
Seriously. But if I were pitching a wild idea right now, based only on this call, here's what I'd pitch. I'm calling it the sweaty equity coil.
The sweaty equity coil. Okay, I'm listening. What's the thesis?
You go long CSWI
Mm-hmm.
right now. The market just puked on this stock because of a winter quarter where nobody buys their main product. But the destocking is ending. January orders are up.
So you're buying the cyclical low, catching the falling knife.
I'm buying the magnified seasonality. The acquisitions make the winter dip deeper, but they should act like rocket fuel in the summer. Mars and Aspen are pure leverage plays on a heat wave.
And you've got the restructuring in SRS hitting right before summer starts.
That's the kicker. SRS restructuring hits April 1st. The ERP is done. Synergies are coming in hot. So you fast forward to June. The first heat wave hits Texas. Everyone's AC breaks. CSWI has a clean cost structure, and the volume just explodes.
You're betting the margin snap back way faster than the street expects.
Exactly. You're not buying an industrial company. You're buying a leveraged call option on a hot summer, and you're getting it at a discount because everyone's scared of the debt. It's a coil, just winding up.
It's outrageous, but it's plausible. The risk, of course, is a mild summer. Or a recession.
A grim thought. But the sweaty equity coil doesn't believe in mild summers.
Well, from a fundamental perspective, the setup is there. And their leverage, we should mention, is 2.3 times. It's not a crazy number for a company post-acquisition.
Right. It's manageable. If they execute, the cash flow this summer should be massive, which pays down debt, which fixes the EPS problem.
That's a self-correcting problem if the volume shows up.
If the volume shows up, that's the phrase to remember.
And that's why we watch that May call so closely.
All right, let's wrap it. CSW Industrials is down, but it's digesting. It's a classic battle between debt today versus scale and synergy tomorrow.
And for you listening, the takeaway is to look past the headline miss. The business isn't broken. It's just heavy right now.
Heavy's a good word for it. Heavy with potential, or just heavy. We'll find out in May. As always, check the show notes for a full breakdown. This has been the Talk Tickers edition of The Deep Dive. Stay curious.
Goodbye, everyone.